Collins & Co.'s not-for-profit conference, Be Empowered Through Knowledge, is designed specifically for the not-for-profit sector. Our speakers are experts in this sector, and their practical approach provides not-for-profit board members and management with the opportunity to improve their skills and knowledge across a range of specialist topics. The conference also provides a great networking opportunity.
On behalf of Collins & Co, I would like to welcome everyone here in the Jim Stein's Room B and also those who are live streaming these sessions. My name is Ryk Eksteen. I'm the Audit Principal and Non-for-Profit Specialist of Collins & Co. What I'm talking today about is changes to upcoming accounting standards ASB 15, ASB 16, and ASB 1058. In the first two sessions, I will cover ASB 15, revenue from contracts with customers, and ASB 1058, income of not-for-profit entities. And then also we'll talk in the third session, I will talk about accounting for leases, ASB 16. In this session, we will learn about the principles of ASB 15. We will learn about the five-step model for revenue recognition and measurement. We will work through illustrative examples. We will discuss the accounting for revenue under ASB 15, and we'll also deal with questions. I've got a bit of time after today's free session, so if you are around longer than the free sessions, I'm happy to take questions then as well, and just work through examples with you. What we won't deal with is the impact on for-profit contracts, as well as we won't deal with the variable considerations that have an impact on for-profits. ASB 15, it was released because there was a shift in the way people need to account for revenue. ASB 118 accounted for revenue under transfer on risk and reward model, and the new ASB 15 deals with the transfer of control model. This new accounting standard is already effective. It's effective for accounting periods from the 1st of January 2018, which in effect means 31 December 2018 year end, as well as 30 June 2019. Well, it could have early adopted if the time hasn't passed already. On the slide, there's exclusions from the scope. I'm not going to read through all of that. That's just straight from the standard. It's in your notes. Your notes is available on the website, or if you can always email me and I can send it to you. Under the old standard, ASB 118, revenue was recognised when it was possible that future economic benefits would flow into the entity and that those benefits could be measured reliably. So basically where there was a transfer of risk and rewards. And that applied for the sale of goods, the rendering of services, as well as income from dividends, interest and royalties. All of that have now been replaced by ASB 15, revenue from contracts with customers. There's some key points under ASB 15. So it brings into the ballgame a totally new revenue recognition model. You now need to decide whether you can recognise your revenue at a point in time or over time. And I think it's probably the way that not-for-profit entities like to, I guess, shift that revenue. And I think this would be probably a more appropriate or more useful standard for you guys going forward. You will see what I mean later on. So this is also revenue that arises from transfer of goods and services to a customer or to a third party under the direction of the customer. It's also, there's a bit of a change in how much you can recognise as revenue, because you can recognise the revenue that you expect to receive and not really go on the full face value as per the contract. But more about that later. There's some new terms here. We talk about are there performance obligations in the contracts. The contract could be modified. We're talking about the time value of money. That's if you have a financing component. May not be as applicable in a not-for-profit space, but you never know. As well as basically to recognise revenue at this point in time or over time, and also talking about variable consideration, talking about transaction price. All those things can have different meanings, which will hopefully become a bit more clear to you. So under ASB 15, there's a 5-step model for the recognition of revenue. The first step one is you need to identify the enforceable contract, the enforceable contract with a customer. So there needs to be a customer and a contract. Step 2 is identify the performance obligations or the significant specific promises that are made in the contract. Step 3 is to determine the transaction price. Step 4 is to allocate that transaction price against the different performance obligations. And step 5 is to then recognise the revenue as the performance obligation has been satisfied. So step 1, identify enforceable contract with a customer. The entity shall apply ASB 15 when the counterpart to the contract is a customer. So I'm just going to read off the slide here this definition of a customer. A customer is a party that has contracted with an entity to obtain goods or services that are an input of the entity's ordinary activities in exchange for consideration. That's quite a bit wordy. Basically, in a not-for-profit space, that will mean like a government department, a state department, could even be a philanthropic organisation. And in a not-for-profit space, a lot of the time that means that goods and services are provided to a third party. A contract is basically an agreement between parties that creates enforceable rights and obligations, and the enforceability depends on the customer being able to enforce these rights. That's where you have instances where you don't spend the money that the government give you and you have to give it back to them. You got money to build a building or do something or create an asset, and you don't meet your obligations and that asset reverts back to the customer. Also where you can be forced to perform a certain obligation and it can actually be enforced by law. So a contract can be verbal, a contract can be in writing, it can take customary forms, which basically, that's probably more a business term. It needs to be legally enforceable. And that it can basically exist in different places, but you need to account for each contract separately. But sometimes, if you look at it on substantive form, that multiple of contracts can actually only be one contract. So ASB 15 requires all the criteria to be met in order for this to be a contract to exist. The first one is the parties need to have an approved contract, and they each need to be committed to perform their separate obligations. You need to be able to identify the various parties' rights. You also need to be able to identify the payment terms. The contract needs to be of commercial or economic substance, and there's expectation to receive consideration that after you do the performance obligation. If there's a unilateral right by both parties to terminate an unperformed contract, then there is no contract. It will not be a contract under ASB 15. So sometimes, in that case, you will basically look at what performance obligations have been performed. You will recognise that income. If there's anything there that you may still going to do, you can recognise that as a liability until you perform that specific obligation. But otherwise, you can recognise it as revenue. Step 2, identify the performance obligations or significantly specific purpose in the contract. I'm once again going to read, performance obligations represent each distinct or specific requirement, a promise to provide goods or services. So the goods or services can be delivered to a customer that the customer can use it on their own or in conjunction with other resources they already have. And there's an and there, the entities promise to transfer the goods or service to the customer separate identifier from any other promises. So in one contract, you can have a lot of different promises or obligations. And you will see later on that becomes really important to be able to identify that as well as to put a value to it. So you can, there's a lot of information on this slide. I'm not going to go through all of it, but it's a pretty comprehensive slide. So there's instances where you transfer services over a period of time. Sometimes that may not be enough. It really depends on what's in the contract, what is the conditions attached to that services. The fact that you've got an acquittal process maybe create an instance where it's significantly specific. Step 3 is to determine the transaction price. The transaction price is the amount of consideration which an entity expects to receive or be entitled to in exchange for the transfers. So for the first time, the concept comes into being where we don't recognize like the full invoice value. We may have a look at a contract and think, okay, we know we're going to deliver 90% of the service, but the last 10% is a bit iffy. We're not sure that's something really been set in concrete, and there's a lot of uncertainty about that part of the contract. So at that stage, you're going to really only recognize or decide to recognize that 90% of the consideration, depending on which performance obligation it's attached to. So there's a couple of things that come here, like variable consideration, which is part of the income is donations, is it incentives, is it discounts. So we talk about expected value and what's the most likely amount you're going to receive. Oops, I think I've done it all. There you go. This also could be a significant financing component where you, I guess the payments are spread over a certain period of time, and I guess if your customer paid that amount to you at the earlier stage, they would have paid a lower amount. So that could mean you are basically, I guess, providing some finance. So that's something you need to look at. And for not-for-profit, and you see no cash considerations, you need to measure it at fair value, and if fair value is not available, then I guess it's the standalone selling price of that product or service if it is available. A lot of the time it's not that easy. Step 4 is to allocate a transaction price to the performance obligations. So if there's more than one distinct performance obligation in the contract, the total price is then allocated to each one based on the standalone selling price of each performance obligation. I think that's going to be a pretty hard thing to do a lot of the time. I'll guess in a not-for-profit space, you would have done your budget. That budget would be break up the various services you're going to deliver or the different products. And I think that will probably give you a good indication of how you're going to allocate your transaction price. Because a lot of the time, you're not going to be able to say, okay, if I deliver the service on a standalone basis, what am I going to charge for it? So I think this will probably be the most tricky part of the 5-step process, basically allocating that transaction price, especially in big contracts. So there's a bit more here on how to allocate it. So we talk about, you could say, if you do deliver that service separately, you can say, what does it cost me to deliver the service? Do I put in a margin on it? And then say, okay, that is what I'm going to allocate to that transaction price. This sounds a bit complicated. Our first example that's coming up is going to explain that. The first time I saw that, I thought, what's going on here? But I'm sure you'll be a lot more open-minded to that. Also, in the not-for-profit space, there's a rebuttable presumption. So where does a dual purpose exist for obtaining goods, services, and the not-for-profit basically achieves the product, you basically treat that whole transaction price as for the services. But that presumption can be rebutted where, especially you're a charity, you're having a fundraising dinner and you're selling the tickets for $600, and $300 of that $600 is a donation, and really $300 of that ticket price relates to the dinner. So suddenly, I can't make it to the dinner, and you're nice enough to refund me, but you say, I'm gonna refund you the cost of the ticket, but I'm not gonna refund you the donation. It's the terms and conditions of the sale. So once that happens, you're gonna end up in a situation where you're gonna treat your the recognition of your income under different accounting standards. You may end up under ASB 15 as well as under ASB 1058. And then step 5 is recognizing revenue as each distinct performance obligation is satisfied. So you've gone through all the steps, you identify the performance obligations, and there's 3 of them. You determine the transaction price, you allocated that transaction price over the 3 performance obligations, and now you come into the stage, you're starting to deliver your performance obligations, and now it's time to recognize your revenue. So you can either recognize the revenue at a point in time, so especially where you deliver goods, that's normally, you deliver the goods, the transfer gets the control of the transfer of control takes place. So that would be at a point in time, or over time. That normally happens in services. So you have been engaged in a 3-year contract to deliver services to the homeless, and so that's something that's not going to be a once-off. It's going to continue to happen over a period of time. Like I said, in point in time recognition is where there's a transfer of control, and that's really very clear where there's goods being delivered. To qualify for overtime recognition, you basically need to have a continuous transfer of control. I'm just going to read this from the slide. Customer similarly receives and consumes the benefits provided by the entity performance as the entity performs. The entity performance creates or enhances an asset that the customer controls as the asset is created or enhanced, or the entity's performance does not create an asset with an alternative use, and the entity has enforceable right to payment for the performance completed to date. So that's basically, as you go along, sometimes things happen and maybe the contract gets suspended, so there's a certain period of time you want to get paid. So we also talk about measurement over time, and then there's certain, I guess percentage of completion, could be a for-profit term, but also a not-for-profit term. So it's the output methods and the input methods, where the output method revenue is based on the value transferred to the customer. So you look at what type of criteria you can use or indications. So it's the goods produced, the service units delivered, it's a contract, you meet your contract milestones. And on the other side, your input methods, it will revenue is based on entities' efforts to satisfy the performance obligations, like the cost you incurred in this project, like the staff labour used, like the client service delivered. So it really depends on, when you set up your budget, you're going to work out what do I need to do in order to obtain that funding. And that's, going to be maybe a way to establish what is your input or output methods, and is that a way you're going to measure your revenue continuously over time. Okay, finally get to our first example. Is there any questions so far? I know there's a lot of, words and a lot of stuff. Yes?
What is the point of changing need and sanity? You alluded to in your last sentence, you said, what do I need to do in order to obtain funding?
Mm-hmm.
If we don't subscribe to these standards, are we not going to get funding?
No, it's really, okay, so this standard replies to previous ASB 118, and what also is happening, the non-for-profit standard ASB 1004, which is contributions, are being replaced by ASB 1058. So it's not about getting the funding, it's about once you get the funding, how you're going to recognise the income. Because I know non-for-profits, a lot of time, I talk about it later, is the big mismatch between you receive the revenue, but you're really only doing the service later on, or incurring the expenses for that specific contract that you got the money for. So it's really then, I guess, they going back to the really old principle of matching, but it's then making sure that your contracts comply, that you can actually do the matching. Because if your contract is not a contract, then you end up with a problem that you need to recognise the revenue when you get it. And then you're going to have a similar problem. So it's really understanding what your contracts are, and then if it's not really going to comply with the standard, go back to the funder, and hopefully they will get on board early and decide, I realise this stuff needs to change, and then make sure that you can apply that standard.
Because when we report back to the funders, the grant providers, you need to report on this one.
Not necessarily, but it's more for your accounting side. I mean, I know they've got their own way they want their reporting done, and I think that a big change will be that in the past you would have recognised $100 in this year, but when you do your acquittal it's 80 or 60. I think it will bring you a lot more in line with your reporting requirements to your funder, because you're only going to get paid 60 when you meet this milestone. So you can only recognise that $60, and when you report back to your funder you have recognised the $60. So it's really bringing that in line as well. Sure.
In one of your slides, you mentioned being able to determine when there's a transfer of good and a transfer of service.
Mm-hmm.
What exactly do you mean by a transfer of service? Is that
A delivery. That's right.
for you, that's the transfer?
That's correct. So once you, I don't know, what type of organisation are you in?
Boston Trading Union.
So you probably do, so you do maybe venue hires. So it's a question, so you do that service, and the moment that, I guess, the party have come in, used the venue, you've got your money up front. So the moment basically that people have used the venue, and then that completes the transaction. So that's the transfer of the service. So, but I mean, it could be like you go out to clients and need to do like some client, I guess, palliative care or something like that. The moment that you actually have performed that service, that transfer of control takes place. So this is the example I talked about the first time I saw it. Sorry, Andre?
A lot of not-for-profits receive something up front, but the charge fund necessarily wants to get funds back. So it still requires them to sometimes transfer the fiscal year. That funding is one that
This is where you have to go and look at your contracts and really nut out, is there a performance obligation? How is the performance obligation set out? So that it's really, the contract becomes the most important document in the whole process now, and understanding what is required and all the different conditions attached to that.
was that reading with regards to the contract that says the contract is enforceable if there's certain customers' capacity to enforce its rights.
Mm-hmm.
If the funder doesn't have the ability to enforce its rights,
It's not a contract.
so the contract won't fall on these.
Yes. So really the contract, I guess, one of the key messages is really what is in the contract. Okay, just an example. So this example it explains basically the whole, I guess, determination of transaction price, the allocation of the transaction price. This deals with a sports club, it could be a school, anywhere where this example deals with the instance where you get like a joining fee or upfront fee, which you say, in the past, I've got this money from someone, I'm going to recognize it because I'm receiving it now, it's not refundable. So that really covers that scenario, but it also gives you, I guess, an example of how the allocation of the transaction price works. Okay, sports club membership, non-refundable joining fee of $4,000. We've got an annual membership fee of $2,000. Ian's 2 freebies, 2 free hires per year of meeting rooms in the first 24 months, normally $500 a day. And the average length of membership is 100 years. So under the old revenue standard, we would have recognized it as follows. In year one, the $4,000 joining fee, and then the annual subscription would have been $2,000 every year for the 10 years. And we really wouldn't have recognized that room hire because we don't know if it's going to happen. It was one of those things, there's no certainty whether the member is going to take up that specific, I guess, benefit to that membership. Okay. So now we go on to under ASB 15. This is the way we're going to account for it. So the calculation of the numbers I'm going to get to. So you're not going to recognise the joining fee at all. Your subscription is going to be $2,215 a year, and you're going to recognise some room hire. And this is how these numbers are also. I'll show you now how these numbers are calculated. So we talk about the club services. So we've got a membership of $2,000 for 10 years, because that's the average membership, the length of the membership fees. We've got a $4,000 joining fee, so that gives us our standalone price after club services. Then we also got a room hire, which is the $5,000 times 2 times 2 years, which goes to $2,000, which gives us a total standalone price of $26,000. But we know we're not getting anything for that room hire. So now we're in a situation we need to allocate the transaction price to the different performance obligations. So we're going to do a pro rata to allocate a portion of the $24,000 to the club services, and a portion of the room hire is going to also be allocated. So that's how the 1846. So that's the 923 times 2. And then the 22154 is basically then your 2215.
Just to go back to that, sorry, the next slide. Yes, the one we got the calculation.
Yes.
So the room hire, that 500 is your cost.
That's right. Or it's really, what is the value? It's if I come in as an individual and say I want to hire this room, it's going to cost me $500 a day. Because I guess one of the things under the standard is if you get something for free, you're not going to recognise nothing. You need to put a value on it, and that does have a value, because anybody can come in and hire that room for $500 a day.
Why have you only had 2 times 2
There are 2 meetings for 2 years.
So you know that we're setting over 10 years.
Yeah, but that's more distinctive, so you can identify that as being happening in the first 2 years. It's not going to continue after that. Yes, Nick, sorry.
Okay, with those free room hires, in your calculation, you've calculated the value in your pricing. So what happens at the end of that 10 years if that room hire doesn't use it?
Then that's a good point. I don't know. But I guess you recognise what you've done is you recognise the 20. So what you've done is you recognise the 24,000, which was your, I guess, the total you expected to receive after the 10 years. You have recognised the 24,000.
The thing is that component over recognised income.
But that, I mean, the $500 over 2 years, you recognise it in those 2 years, if he doesn't use it, well, that's...
It is tough.
You just don't have months.
Yeah. Yeah, it's basically, yeah, you're going to end up with recognising 24,000 over 10 years. It's just, I guess, the way you do it. And whether they use it or not, I guess it probably doesn't matter. Okay, sorry, yep.
There's no assumption to charge value for money here. NPV, we are not looking at NPV here with anything. It's simple scale calculation, maybe an hour.
In some instances, you'll see time value of money. I guess this is a really simplified calculation to explain really the allocation of the transaction price over the different performance obligations. So, yep, sorry.
What's the standard requirement of that? Do we need to incorporate time value of money as per ASB 15 or only of that?
I'll have to take that on notice. Can you just come and see me after the session and I'll just write it down? Sorry, any other questions at the back? Richard? Or Mark, sorry?
The room hire, surely you would, if that's part of the contract of the membership, you need to, I would expected that if the member takes up the opportunity, that's when you, but that's a timing issue, so that's when you recognise the costs, as opposed to simply saying, well, that's the offer, we apply the costs over those 2 years.
Yeah, there's no, I mean, it's whether, I guess my understanding is whether you take it up or not, you recognise it because you have this chunk of money you're recognising over the 10 years. I don't think it's going to matter whether they use it or not. It's just your revenue in a different format. So if they took it up, great. If they don't, I guess it's more like...
Yeah, it's just interesting considering the earlier parts of the ASB. It's the critical thing of reading the contract and certain events taking place.
Yep. So I guess after 2 years, then if you do put it on the balance sheet, you can, I guess, put that portion on the balance sheet, and then if they use it, you can recognise it, and if they after 2 years don't use it, then you recognise it. So that's another way to do it, I guess. Any further questions?
What about if they leave after 2 years instead of 10, so your revenue received 4,000 and the two charges 2,000, your revenue received 8,000, but you only accounted for it as you go back to the other 3 years.
So
You only accounted for it as 2,215 for 2 years and 923. So what happened when you do the extra money?
I would suspect that you're going to have the $4,000 that you haven't recognised in full in the first year. You're going to have a portion of that sitting on the balance sheet, and the moment they leave, you're going to recognise the whole lot. The other things, your annual subscriptions, just something's going to happen every year, so you're not going to have it sitting on the balance sheet as a liability. It's just, but that one, because you really recognise that over time, you're going to have the liability and then work it down. Any other questions?
With the joining fee, you're actually working out the average length of the member.
Yes. That's right. And that's how you recognise it over that term. And I mean, it does vary, so it can change a lot. So that's a bit of guesswork. So, but I guess you go on the history. What is the history of the membership? Yes.
When you have a membership that comes with a series of things, for example, a retirement village, you move in, you have access to the community facilities, not just for 2 years, but 10 years that you live there. Or you might have access to booking out the cafe or whatever. Are we expected to break these things down and, you've got your line for room hire instead of 2 years, it's 10 years, your room for community facility?
It comes down to what is the different obligations under that contract. So it is nuts, but really comes down to what are you have to deliver under that contract. So the people are entitled to stay in their independent living apartment. So what else goes along with that? So you really need to, what is your obligations and what can that person, so, okay, if they don't use the community, they don't use the gym, I guess it gets a bit tricky because, okay, so let's say it's a gym and it's free membership and it's as long as you want to, but I mean, they don't use the gym, so what do you do now? I guess a similar situation, I guess, where you park that portion of the revenue until it gets used or something. It's not a simple thing once you get into the detail of this. Yes, sir.
We wouldn't know when they use it.
I know. So it's really the measurement.
So it's not measurable, sure.
But do you get an average? So do you
We
know
don't know.
what do you think?
No.
Oh.
For 600 clients, no.
It's a
They
building,
think
it's
for
not
themselves.
monitored, it's a community building, we don't
Yeah.
sign in and sign out.
Oh, okay.
So I guess I mean there's a lot of things that obviously that's a lot more complex than some of the other things, but there's definitely you need to look at what's in the contract and then I guess the measurement and can you actually quantify what is the value of the person going to the gym and things.
So we need to make the contract very simple.
Yeah.
So isn't the real underlying principle is really matching the revenue to the cost?
Yes.
That's it. So if you sort of, in your budgeting, your forecasting, in your pricing, your forecast is what it's going to cost me, that's what my price is. It really is recognising that revenue as per your assumed cost. Because a lot of it will be assumption.
Yep. I mean, it's no hard and fast rules, unfortunately. I guess the principles are there, but I guess once you get, I guess part of the problem is the people that written these standards don't have to apply them. And that's why everybody's here, and that's why I'm trying my best to, I guess, make it, I'm not making it a lot simpler, but I guess we're trying to arm people with some knowledge, because this is a bit of an introductory session, that you can go away and think about this and say, okay, either it's going to be easy because our contracts aren't that complex, or there's a lot more to think about, a lot more work to do to work out what we need to do. Or maybe you have to, it's basically going back and talking to someone that knows the stuff and say, okay, what do we do here? Because we've got so many things caught up in this contract. Do we make our contract simpler, or what do we need to do in order to comply with this? That's at the same time, yep. Okay, so Andre is basically suggesting because the availability or the access to the gym basically coincides with the access to the accommodation, it wouldn't matter, I guess, how you allocate that specific income to the gym, because that really is just all together, it's whether they use it or not. Okay, yep. So Andre is suggesting basically depends on the contract, and if there's a certain short period of time connected to it, or it really depends on the contract in the end of the day. Any more questions? In the front here, have you answered? Okay, cool. Everybody's happy so far? Okay, now we come to the stuff that I guess people are more familiar with, grants. So, adult reading program funded by the state government through a contract signed by both parties. It covers the funding for the 1st July 19 to 30 June 20. Must be delivered in a defined region, publicised for councils and local media, made available to any applicant assessed as eligible. Unspent money, failure to meet conditions, to repay to the state government. Okay. And then the first instalment is 200,000 received on the 26th of June 2019, and then the remaining 800,000 received in 19-20 year. So now we're going to have a look at how do we account for that. And I guess it's pretty logical, and it's the same way you would do now. Is you get the money on 26th of June, debit cash, credit your income in advance, and then by 30 June 2020, you would basically debit the income in advance, or over time, I guess, as you deliver the service. The bank is debited with the 800,000, the total grant income is $1 million, your program expenses $1 million, and you paid out $1 million. I don't think that's pretty straightforward, because what we assume here is that it is a contract based on the fact that you can identify what needs to be delivered. You basically, okay, you've got a contract that's signed. First, it specifies a period, specifies what needs to be done for that money, and if you don't spend the money, you have to repay the money. So that's the contract. Example 3. So, same scenario, we've got the adult learning program funded by state government through a contract signed by both parties. The funding covers the 1st July 2019 to 30 June 2020. The money is to be applied to support a service agency to provide to continue its objectives. The agency has stated objectives is on improving adult literacy. Failure to spend the money requires refund of the money. Same scenario, first instalment on the 26th of June and the rest in the next financial year. So, suddenly we have a situation where you recognise the income, and when you received it. And then, so you recognise on the 26th of June, you recognise the 200,000 as grant income, and then by 30 June, it basically it's the same as the previous example, cash in 800k, granting income 800,000 to spend the money out of the bank. So what is the difference here? So why did I do that? Okay, if we go back to, let's go back to the, that's good. I'm not sure I know, but I can tell you.
And there's no specific objectives. It's about delivering local services, about the adult literacy programs, the first contract, and very specific.
So Paula's right with that. So there's no significant specific promise to deliver the service. So there's no indication by the state government you have to spend the money on this project. So this is just basically, here's money, you can spend it on basically anything that you do in your organisation. Even though there is basically a requirement to pay the money back, it doesn't meet all the conditions of ASB 15. At the back?
No, that's what I was
Okay, no problem at all. So probably just a similar. I'm just gonna. It's really the same example. So a similar example. A charity is contracted to operate dwellings for the homeless, including providing council and other services to inhabitants. The charity received 15 million on 15 June 2020 to provide counselling service to inhabitants for a specific number of hours per week. The funds must be refunded if not spent prior to 30 June 2021. And then example 2 is basically a charity is contracted to operate dwellings for the homeless, including providing counselling and other services to inhabitants. They received the 15 million to be spent on the charity's overall objectives. Same thing, it must be refunded if not spent by 30 June 2021. Similar issue where we don't have that specific criteria attached to the money. So under A, it's the contract would account, the charity would account for the 50 million payment in accordance with ASB 15 as there is an enforceable contract. They must refund the money, and agreement is sufficiently specific as to the nature of the service to be provided and the time period in which the services must be provided. A contract ability for 15 million would be recognised on receipt, and the revenue would be recognised when the province's services are delivered. And that's very much like the way charities like to do it. I know I love this concept. Number 2 is basically, while this contract creates enforceable rights, the agreement does not contain a sufficient specific promise to the customer. So the time restriction in itself is not sufficient. The fact that it is basically, it could be over 2 years. They could have given you 50 million and it lasts for 3 years. It doesn't matter. If it's not, doesn't have that sufficiently specific promise, you have to recognise it now.
Sorry, Ryk.
Yes.
This whole legal enforceability, I think is what you're talking about.
Yes. No. Yep. Sorry.
I mean, a lot of us charities have a strong moral obligation
Yep.
to use the money as the donor or grantor would request, but this is not legally enforceable. So under the they wouldn't fall into ASB.
That's right. It will be recognised.
It just creates absolute chaos on our perspective, because you may get a massive grant for a tax year from a charitable organisation. They can't legally enforce it, but you've got a strong moral obligation to use the money as they want you to use it.
So they can't get the money back.
Oh, but they do get the money back. So you have situations where you say, no, you can't deliver on, let's say for Susan's case on diabetes,
Yep.
not doing this.
Yep.
And so we'll pay the money back. So, we may recognise income and try to do.
I think there will be quite a big move to really look at that agreements with this type of organisations, so that you will go in and you basically say, I guess, structure that you can actually apply ASB 15. If you have a situation where the money's for over a long period of time, you don't want to recognise it now, and just because your paperwork doesn't say that.
But you know what the stupidity of this is? You can't actually make it enforceable with the license, the right to get tax deduction. You've actually got to say, don't pay me yet. Pay me when I'm using it. That's the stupidity of this. Never mind.
It does have practical implications, yeah.
I have a rant once every time.
At least somebody's passionate about it.
The same thing is we're having a very big
So it's really the old non-reciprocal concept. Okay, what example are we up to? Example 5. Okay, so this is really just a reiteration of the same thing. A training organisation receives a grant from the government to provide first aid training to members of the community. So it's right there, talk about consideration, customer performance obligation, and it's the customer, even if it's the government, the service go to the third party beneficiary. So you'll have a acquittal process, and it needs to be refunded if it's not been spent in the right way or on what the government specified, and it's over a period of 3 years. That 3 years will only come in because it needs to be spent on something specific, basically. Because it needs to be spent on first aid training, you probably have to acquit to the government, this is how much units are delivered and all that type of thing. That will make it a contract. Okay, so basically it's recognised revenue as the training is delivered over time using the acquittal process as a measure of progress towards completion. So that's where we talk about the output measurement of completion, where you can see, okay, maybe when they come to you initially, the requirement was we give you $3 million, but you need to deliver $100,000 hours of training. So that $100,000 is basically going to be your matchstick, how you're going to measure how far you got into this process and how much training have you delivered so far. Fun and games. Okay. Nick, you had a question?
This has to be equally as applicable to, say, capital grants.
No, it won't. It will, ASB 105.8 applies to capital grants. Okay, just another example. So you sell a membership that access to facilities. You basically also invite your member to donate voluntarily a non-refundable amount to assist the museum with its community objectives. So clearly you've got two different arms to, you've got a membership fee as well as a donation. And neither the membership or donation is refundable, so that's one example. And the next one is the same facts, but the membership can be refundable if it gets cancelled, which in fact means your donation's not going to go back. So in scenario A, where neither is refundable, so the total consideration is allocated to performance obligation to provide the membership assets, and it's wholly within ASB 15. So this is where we talk about the rebuttal presumption. ASB 15 includes a rebuttal presumption that the transaction price is treated as wholly related to the transfer of the goods. So even though you have two different things, it's not really a performance, there's only the one performance obligation, and that's the membership. In scenario B, you can suddenly there's a breakup between, suddenly the membership and the donation is not one thing anymore because the presumption has been rebutted. You now suddenly have membership fees and you've got a donation. So the donations you can recognise under 105.8, while the bit of membership that you did receive are going to be under ASB 15.
With the donation thing, so we run membership and we collect donations.
Mm-hmm.
Donations are treated separately because we're a not-for-profit organisation and we have a charitable account.
Mm-hmm.
So the donations go into the charitable account and the tax deductible for that.
Yep.
And the memberships, because we're providing a service, we can't claim those and run them through the charitable account.
Fair enough.
So they would be treated the same under this.
Depends on, are they related? Are you basically asking for the donation at the same time you're asking for the membership?
We do, because they generally put it all out on one form.
Mm-hmm.
So we're just starting to set this up now, but so we are accounting for them differently, because they're going through different accounts.
Yep.
Some of them are charitable, and some just not charitable, it's just not for profit.
Yep.
So,
But at the moment you basically recognise that donation as you receive it.
yeah, well, yeah.
I don't think that will
It
change.
doesn't matter that it's going through.
No. I guess it's more where you,
I'm obliged to do it.
I guess it's your I think it's going to be whether it's with the membership or it's okay. You can have donations that come in separately, so that's going to just be straightforward. Recognise it. But I guess it's really you're still going to continue as you always do. What they trying to. I think they are confusing the issue a bit with saying okay, it's going to be spread. I think you're going to continue on as you always do. So what happens with the membership? Can they basically get money back when they leave?
We've not had anyone leave, so I'm not doing that.
Well, that's good. Just tell them never to leave.
You're not allowed to leave.
So do you recognise your membership at the moment over time or just when you get it? Because is it big? How much is your membership?
It's only nominal, it's like $90 a year.
So you spread it over the year or?
Yeah, so every member knocks off on the 30th of July, the open memberships off on the first month, so they run financial years. We take pro rata as it gets through the year on membership. If a new member signs up in the middle of the year, we give them pro rata. Full year is $90, everyone drops off in the June.
So so you're not taking membership in April to the next April. You're just taking it from April till June. And if you received it, if you received your income in July, do you then say, okay, I've received, let's say it's $120, $10 this month, $10 the next month? Is that how you treat it, or do you recognise $120 in July?
Yeah, we recognise it as it comes in.
Okay, I think it's probably it's not going to. This is not going to change anything you do. So, the way I see it. Let's qualify that one. Okay, so there is transitional methods. So you've got a choice between full retrospective application or cumulative. There's another one is the cumulative catch-up approach. The first one is basically you basically recalculate all contract at the earliest comparative dates, and you restate your comparative. So there's the comparatives you're going to restate. You're going to have an adjustment to the opening balances. But there may be some other exemption stuff available which I don't have on here. I don't recommend this approach. If you want to make work for yourself, sure, but otherwise, no. The cumulative catch-up approach, comparatives are not restated. You change your opening balances, and that will probably mean a adjustment to your opening retained earnings, and you'll apply it for new contracts going onwards from that date. Any questions? Anybody want to make extra work for themselves? No, didn't think so. Okay, so the key considerations. Basically, you need to identify the different type of revenue arrangements. So, like some organisations will be pretty simple, but others may have more complex ones. I guess going back to the retirement village, that can be very complex. So it's really you need to go back and look at all of that, and you can't wait until next year. You need to start now. You basically need to identify and understand the contracts of each arrangement. So that's why people like, for example, Optus, boy, they give you choice, don't they? Imagine the drama they have to go through to get all of this done, because there's so many variations. So it's really, I guess the message is to keep it pretty simple. You don't want to be too fancy, because you're making a lot of work for yourself. Basically, document your judgments and choices. So what did you decide to do? Okay, are you going to follow the full restatement approach or the cumulative catch-up approach? And basically, you need to work out what is the difference, and you need to communicate with your stakeholders and basically work on what you're going to disclose and how you're going to disclose in your financials. Is there any questions on that?
Yeah, so we get sponsorship as well.
Yes.
And we do some promotion for those organisations. Do we put that down then as insanely expensive advertising? Because funds a lot of our poor things. So we've said in our contract, we'll give them full page advertising in our books, and we'll, do.
Yeah, so there's suddenly you're going to have a lot of different obligations.
Expensive advertising, or how do you manage sponsorships?
I think I guess the key message is it can get down that path where it's so nuts. If you're having that many things that you want to say this and this and this is what you can do for you, so having a membership of the MCG, I'm sure they're having fun working all of that out. So yeah, you're going to need to go back and what's in it and what are you actually saying, and how are you going to actually determine your transaction price? How are you going to allocate your transaction price? That's the fun bit. I think yep. Sorry.
Is your suggestion that the cumulative restating past statements, is it your suggestion that the best option is the cumulative approach?
Yes, that's the least amount of work, because otherwise you have to go back historically and look at all the different things that. I guess what it means is you have to go back to the ones that you started a contract 5 years ago, or 4 years ago, and it's still running, and it's going to be running in the time that this thing kicks in, or it already kicked in, or whenever it kicks in, and you want to go and calculate all of that and then work out the numbers and then do that, or you can basically ignore everything that happened before, go and work out what your balance should have been the end of on your opening balance, what's your current balance, and then make the adjustment against retained earnings. That's the least amount of work.
Yeah, so well, we're to calendar year, so 1st of January you do revise the
Depends on when your year end starts. So we talk about what's your year end?
31st of December.
Okay, it will be the 1st of December. Now, it will be 2 months ago, yep. Yes. Yes.
A charity offers a membership option of life membership for a lump sum. For example, one of them involved in Menzies, it's $300, you pay it up front, and then you're a life member. How do you recognise that?
Good luck with that. I think you're probably going to go to actuarial calculation. You're going to go to the table that say, okay, the person is now 50 years old. Okay, we expect them to live until they're 80, so over 30 years, I would say. You know, it's nuts. I guess it also comes down to, is it material? But the problem is, do you have hundreds and hundreds of them, and that amount ends up being material? But if you have one or two, I think that we're eating into our morning tea at the moment, so we're back after morning tea. So there's the standards, that's the links to the standards, and then we can deal with things further on. Okay, thank you.